Hi, this is Professor Lazarus again, continuing our discussion on adjusting entries. In this segment, we're going to talk about unearned revenues. So let's get right into our transactions here on the board. On January 1st, a CPA receives $2,000 of cash in advance of services to be provided. Again, he has not provided the services yet, but he receives the money in advance from a customer. So the entry that the CPA will make on his books, on his own company books, will be debit cash to increase the cash because that's how much he has received. And the offsetting account will be a liability account called unearned revenues. Please do not confuse unearned revenues with earned revenues. Unearned revenues is a liability account. Let's examine why is it a liability account. When the CPA received $2,000 of cash in advance, at that moment when he or she got the money, they owe the customer the service, the work to be done, or if they choose not to do the work, they have to refund the money, isn't it? So again, the CPA at the time he or she receives the money owes the customer the work, or alternatively owes the customer the money. The keyword is owe. So therefore, the offsetting account to cash in this case would be a liability account called unearned revenues, and the CPA's liability has just increased when he received this cash. Now let's fast forward to next month. This was in January. Next month, during the month of February, he finishes the work. He starts the work and finishes it all in February. So if this is the case, then at the end of February, the CPA is required to make an adjusting entry. What is the purpose of this adjusting entry? The purpose of this adjusting entry is twofold. Remember, it's a double entry system. One reason for making the entry is to show that he now has earned this $2,000 that he had received last month. And in the process of earning the $2,000, what happens to his liability, his unearned revenue liability? That liability does not exist anymore. Why? Because once he has earned the money, he does not owe the money any longer to the client. So therefore, the adjusting entry we're going to make reflects these two things. What two things? We have to reduce the liability by $2,000, and we have to show earned revenues of $2,000. So the accounts in this case, the adjusting entry will be a debit to unearned revenue to reduce the liability, get it off your books in this case, and to credit a revenue account called service revenue for $2,000. Let's assume that the CPA only did half the work in February and the other half in March. If that was the case, then he would make the same entry in February but only for $1,000. And then at the end of March, he would again repeat the same entry for the remaining $1,000. So that would be the only variation to what I just showed you here on the board. Now earlier I had noted up here that unearned revenue is an example of a deferred revenue. Let's try to understand why we call this a deferred revenue. As you may recall from earlier discussions, deferred means postponed to a future date, isn't it? So when the CPA first received the cash at the beginning of January, that cash was not recorded as a revenue, but that cash was recorded in the cash account, and then the offset was a liability. And later in February, when the CPA provided the services, that initial liability then became a revenue. So the revenue recognition was postponed to a later date. What later date? A later date when the CPA completed the work. This is why unearned revenue is an example of a deferred revenue. So again, the CPA did not recognize the revenues when he got the money, when he received the cash. Instead, he recognized the $2,000 as revenues a month later when he completed the job. Okay, question to ask ourselves then. What if we did not make this adjusting entry? What if the CPA omitted this adjusting entry? What would be the effect on his financial statements? As I've said before with other adjusting entries, when you get a question like this, it always helps to write out the adjusting entry anyway, because it's easier to answer the question that I just posed when you're looking at the adjusting entry. So if you did not make this adjusting entry, then what would happen is, and we have it listed here, if you did not make this adjusting entry, your unearned revenue would be overstated. I have an arrow going up, would be overstated. Your service revenue would be understated. If your service revenue is understated, then your net income also is understated. And as you may recall, your net income gets closed out into your equity account like retained earnings or capital. So then your equity also would be understated. Well, in conjunction with that, the next question we want to ask ourselves is, are our books in balance if we don't make this entry? And I think by now, after listening to my earlier segments, we should know the answer. And yes, the books will still be in balance even though we may not make this adjusting entry. How so? Here's the proof again for that. Here's the accounting equation. Assets equals liabilities plus equity. So if you don't make this entry, no effect on your assets, so no change there. But on this side, your liability gets overstated and your equity gets understated, both by the same amounts. So each family offsets the other. So the net, the cumulative effect of these two would be zero. So no change on the right side, no change on the left side. So yes, your books will still be in balance. Your account totals will be wrong, but you'll still be in balance. And as I've cautioned you before, this is one of the dangers of accounting, where your books may be in balance, but you are still wrong. Your accounts are still wrong. So that concludes our discussion on unearned revenues. I hope you have a better appreciation of this concept and the adjusting entry that is associated with unearned revenues. Thank you.